Welcome to Phillip Futures Weekly Market Watch. I'm Han Qiang, investment analyst from Phillip Futures. The China Securities Regulatory Commission, in short CSRC, now allows brokerages, insurers, hedge funds, private equity and venture capital groups to launch mutual funds in China. We will discuss the objectives of such measure, implication on China's capital markets, and how we can capitalize on it. This is a 3-year chart showing Shanghai Composite Index. Equity-focused funds have suffered from the poor performance of Shanghai stock market in the past 3 years, as it declined 44% peak to trough, from as high as 3,400 to 1,950. This is a 1-year chart showing Shanghai Composite Index. Recent stock rally of about 25% has caught the attention of investors. Deregulation at this point in time has the effect of revitalizing the mutual fund industry. Deregulation provides greater investment options and more investment opportunities, which translate to lower investment costs. And this is good news for investors. There are 4 reasons why the mutual funds industry in China is being opened up for greater competition. The first is to bring up the buying among institutional investors in China's stock markets, which is currently about 14%, as compared to more than 50% in developed markets. Recent stock rally of about 25% has caught the attention of investors. Deregulation at this point in time has the effect of further revitalizing the mutual fund industry. This is the second reason. The emergence of a property bubble has more to do with capital controls that discourage investors from moving their savings abroad and thus encourage speculation in the domestic property market. Deregulation provides greater investment options, provide more diversified saving and investment options for the Chinese, and therefore has the effect of taking some pressure off property prices. This is the third reason. Lastly, this deregulation is one small step towards making capital markets more liberalized in China, in making capital allocation more efficient, in providing the middle class with greater choices about where to put their money, so they can earn a higher return and therefore spend more. In the long run, this should help rebalance growth from investment to consumption. This deregulation will just be the first of many to come, and this implies that there will be potentially many new investment vehicles being offered in renminbi going forward. Dim sum bonds, bonds denominated in renminbi but issued outside China mainland, is one such investment vehicle that is popular right now. In November 2012, China Construction Bank is the first Chinese bank to issue a renminbi denominated bond in London. In February 2012, the first renminbi denominated gold ETF started trading in Hong Kong. It is managed by Han Qiang Bank and is designed to track gold prices and provides returns in renminbi. More investment vehicles offered in renminbi are in the pipeline. According to World Gold Council, China is likely to launch its first ETF backed by physical gold this year. The launch of gold ETF will be the next step to liberate China gold market, which has seen investment demand surging from just 15 tons in 2006 to 265 tons in 2012. How can retail investors like us take advantage of the liberalization of China's capital markets? For international retail investors, non-renminbi denominated China ETF listed in US are better because there is better liquidity, therefore liquidity cost is lower. Inverse ETF that profits in a bear market is also available. However, one area to be careful about is the exchange rate risk, because these ETFs are denominated in US dollar. Your risk is that US dollar depreciates. For mainland retail investors, renminbi-denominated China ETF are more popular because there is no exchange rate risk for them. However, liquidity cost is usually high for new ETFs. For investors who desire benefits of leverage, futures contracts are cost-efficient in gaining exposure to the China economy. Phillip Futures offer SGX FTSE China A50 Index Futures contract. It tracks a basket of the 50 largest A-share companies by market cap, listed on the Shanghai and Shenzhen stock exchanges. This is the end of my presentation. For more information on China A50 Index Futures contract, please approach any representative from Phillip Futures for further discussion. Thank you. Tune in to next week PhillipCapital Market Watch.